Do you know how Canada taxes the dead? In Canada, there is no formal inheritance tax unlike in the United States. Therefore, when an individual passes away, their tax affairs undergo a process known as the terminal return, which is the last income tax return for a deceased person. The Canada Revenue Agency considers the deceased as if they sold all their assets at fair market value just before death. This situation is referred to as deemed disposition. Below, we discuss how this process impacts various types of personal properties and accounts. The principal residence: if the property qualified as the deceased's principal residence for the entire period of ownership, the principal residence exemption applies. Result: no capital gains tax is due on appreciation. However, if it was only the principal residence for part of that time, some capital gains may be taxable for the years the property is not designated as a principal resident. Upon death, the property transfers to beneficiaries according to the will, or via intestacy rules if there is no will. Important to remember, only if the property is fully paid, lender requirement may not allow the transfer if there is still a mortgage. If the property is passed to a spouse, rollover rules apply, allowing the transfer at its original cost base. Thus, no tax is due at this stage and is deferred until the spouse sells the property or dies. For registered retirement savings plans, RRSPs, unless transferred to a qualifying beneficiary, the entire value of the RRSP is counted income in the deceased's final tax return, and taxed accordingly. However, if transferred to a spouse or common law partner, the RRSP can roll over on a tax-deferred basis into their RRSP or RIF. For a dependent child or grandchild who is financially dependent and either under 18 or infirm, special rollover or annuity rules may permit tax deferral. For other beneficiaries, the RRSP is fully taxable in the year of death. For pensions, CPP, OISH, employer pensions. CPP death benefit is taxable to the estate. OISH and CPP payments monthly payments halt at death, and any received after must be repaid or reported on the final return. Important: report the death to Service Canada as soon as possible. Employer pensions may provide a survivor benefit to a spouse or dependent, which is taxable to the recipient. Please check with your appropriate pension plan administrator for more details. For other properties such as real estate, investments, businesses, excluding the fully paid principal residence with named beneficiaries, stocks, and business interest, are deemed sold at fair market value upon death. Any capital gains are reported on the final return, with half included in taxable income according to standard capital gains rules at the time of death. If these assets go to a spouse, tax can be deferred using the spousal rollover provision, meaning tax is not triggered until the spouse sells the property or dies. Final return and probate: the estate must file the deceased's final return, also known as terminal return, reporting all income and deemed dispositions. If the estate retains assets for an extended period post-death, it may also need to submit T3 trust returns to report ongoing income. Probate fees, known as estate administration tax in Ontario, are assessed based on the value of assets passing through the will, needing to be paid before estate distribution. This process guarantees that all tax obligations are settled prior to asset distribution to heirs. While no separate inheritance tax exists, tax may still arise from deemed dispositions and income inclusion. Proper planning and a thorough understanding of these regulations can help reduce tax consequences for both your estate and beneficiaries. Tax-free saving account, TFSA, treatment at death: when someone passes away, especially if they are single and childless, the rules governing their TFSA are specific. For instance, there is no successor holder, only a spouse or common law partner can be named as a successor holder for a TFSA. Therefore, if the deceased was single and without children, there is no eligible successor holder. Consequently, the TFSA status ceases to exist upon death. The TFSA assets become part of the deceased's estate. The fair market value at the date of death can be paid to any named beneficiary, if one exists other than a spouse, or else be included in the estate to be distributed as per the will or provincial succession laws. The tax treatment: income or growth earned within the TFSA before death is not taxable. However, any income or gains generated by the TFSA assets after death are taxable, either to the beneficiary or the estate, depending on how assets are distributed and held post-death. Probate: if there is no designated beneficiary, TFSA assets flow through the estate and may incur probate fees, estate administration tax in Ontario, before being distributed to heirs. Final thought: if the deceased was single with no children and lacked a successor holder or a named beneficiary, The TFSA is wound up as part of the estate, losing its tax-free status upon death, and subsequent earnings become taxable. Proper planning, such as naming a beneficiary when possible, can simplify administration and help minimize fees. Visit us online for more at www.taxmate.ca.